On this edition of Worry-Free Living TV, 3 reasons to avoid variable annuities and what to do if you already own one. Our question of the week: hey, what happened to my Social Security benefits statement? You know, that thing Social Security would send me every year around my birthday. I'm not getting any more. What's up? And our story of the week: a big, fat Greek trip and a rather unique and humorous way of showing off and displaying your worry-free bandana. I think you're going to like it. I want to share with you 3 reasons why I think you should avoid variable annuities and what you need to do if you already own one. Variable annuities have become very popular, especially in the market turbulence, because a lot of them have a rider or several different riders that give you a guaranteed income for life or a guaranteed withdrawal benefit. But even in light of all those fancy features, I still think variable annuities, for the most part, don't make any sense for 3 good reasons, and here they are. Number 1, they're expensive. When you look at the expense ratio or the expenses of a good quality no-load mutual fund and you compare that to a variable annuity, the variable annuity is double, sometimes even triple the cost of a quality no-load mutual fund. And quite frankly, those added costs just can't be overcome with the so-called added benefits, the withdrawal benefits, the income for life benefits. They just can't overcome all those extra costs. Remember, there is no free lunch. The second reason that variable annuities don't make it on our list of worthwhile investments is liquidity. With most variable annuities, you're subject to early withdrawal penalties. They're called surrender charges, and these withdrawal penalties can run anywhere from 7 to 10, sometimes 15 years. So, most common is 7 to 10 years. And all that means is, if you need your money and want a lump sum of money out of your annuity, you're going to be paying withdrawal penalties, sometimes significant, substantial withdrawal penalties. So we're not happy with the liquidity or the access to money that you have with most variable annuities. And the third reason that I think it makes sense not to use variable annuities is you lose several important tax benefits, tax advantages that people just kind of forget about, I guess. Now with a variable annuity, your earnings aren't taxed until you withdraw them. That's kind of cool, kind of like an IRA, tax-deferred investment account. Here's the problem with annuities, though. You lose long-term capital gain treatment. So all the profits that you're accumulating inside that annuity, hopefully it's profits, right? Not losses. I'll get to that in a minute. All those profits that you're accumulating, when you do start pulling money out of your annuity, guess what? You're going to be taxed at ordinary income tax rates. You lose the opportunity for the more favorable long-term capital gain tax rate. Now, what happens if you lose money in a variable annuity? You can't claim the loss. So you lose the benefit, you lose the opportunity of matching investment gains with investment losses. And quite often, we can accomplish pretty close to the same tax benefits that annuities do without having to get wrapped up in the extra cost of annuities, just by matching investment gains with investment losses. Oh, and what if you're not going to ever in your lifetime use the money in your annuity? Well, you're creating an income tax burden for your heirs, because unlike a regular stock or a regular mutual fund, the annuity, if it's inherited by your heirs, by your kids, let's say, they don't get a stepped up cost basis. And that's just a fancy term for meaning that if someone inherits a stock or a mutual fund from you that has accumulated profits that you would have been taxed on, but now they've been passed on to another person, that party doesn't have to pay your accrued profits, your accrued capital gains. Their cost basis becomes the market value of the account the day they inherit the account, unless they inherit an annuity. then their cost basis is your cost basis, and they get to pull the money out. Actually, they're forced to pull the money out and pay at ordinary income tax rates. So there's three very good reasons why I have a hard time justifying use of a variable annuity in most of our client scenarios, which begs the question from time to time, what if you already have a variable annuity? Well, in most cases, when you actually crunch the numbers, here's what you're going to find. You're not going to like it, but here's what you're going to find. You're going to find that the hidden fees and expenses inside a variable annuity make sense and justify you going ahead and terminating the variable annuity and moving those monies into quality, no-load mutual funds. We prefer index funds, exchange-traded funds, the lowest cost investment vehicles out there. And when you compare hidden fees and expenses with the absolute lowest cost fees and expenses with ETFs, what you typically find is you end up saving yourself a ton of money. You just don't see it because of all the hidden fees and expenses in these types of contracts. So the bottom line is you need to re-examine whether or not a variable annuity is for you if you already own one. If you don't own one, I would encourage you not to purchase one. This week's question, and we've gotten this frequently here lately, I used to get a Social Security benefit statement on or around my birthday every year, but now I'm not getting one. What happened? Well, the answer is real simple. Nobody's getting them right now. As of March of 2011, the Social Security Administration stopped printing and mailing those statements to save money in the budget. And the projected savings is maybe $60 million a year, which sounds like a lot of money, but when you compare it to our budget deficit, it's really not that much money after all. So the hope is, and the intent is, for the Social Security Administration to move this information that's on your benefit statement, move it from a print version to an online version, and hopefully their intent is, we'll see how that works out, to have that in place by 2012. No specific dates mentioned so far. So what to do in the meantime? Well, also by 2012, they hope to resume sending printed statements to anybody who is over 60 years of age. Now, what if you're under 60 years of age and you want to get a printed benefit statement? My understanding is you still can, but you're going to have to contact the Social Security Administration and ask them to send you one. But that all happens next year. For now, if you want information on your Social Security benefits and what they may look like in the future, the Social Security Administration is telling us we need to go on to the main Social Security website, which is ssa.gov, and there you can find a button to estimate your retirement benefits. Click that button and follow the instructions from there. Our story this week is in honor of the Greek debt crisis that's been making the news here lately, so I thought you might enjoy a story from one of our clients who took a 3-week trip to the Greek islands. And they also had a rather unique way of showing and displaying their worry-free bandana. I think you might get a chuckle out of it. Oh, and by the way, just by coincidence, or maybe not, shortly after they returned from their trip, the Greek government started or the Greek economy started to experience its downturn. So now you know who the real culprit is for the Greek debt crisis. By the way, you can see the entire story on the Bandana Journal website. And don't forget to share your story with us too. Just send us your thoughts and pictures, and you never know when your story may show up in a future edition of Worry-Free Living TV. Let me know what you thought about today's show. Share your thoughts, comments, or questions in the comment box below. And remember, we're here to help you make smart choices about your money so you can live worry-free, doing what you want, when you want, where you want.